Personal finance practice problem using OneNote. Debt payments to income ratio. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, the Practice Problems tab, down in the 5122 Debt Payments to Income Ratio. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below, information giving us the gross pay that we have and some of our debt payments. Now, as we think about these types of ratios, note that we don't have as much standardization as we might have on the corporate finance type of things. In other words, if you're using standardized ratios, they're somewhat more standardized when you're thinking about corporate finance or when you're making decisions on corporate financial statements. On the personal side, we might not have as much of that. However, it can depend on what you're using the ratios for. In other words, ratios are really important because ratios allow you to do comparisons where you would not be able to do comparisons otherwise, because when you're just using static numbers, you can't compare to other people that have different finances but are in a similar situation. So you got to use the ratios. Institutions will, of course, also use the ratios. So if you were to be asking for a loan or something like that, then you'd want to make sure that you are putting together the ratios that they ask for in alignment with what the institution wants. And obviously, if you're looking for a loan, you also just want to keep in mind that you're trying to look better when you're trying to get a loan. So the goal of getting a loan, if your goal is to get a loan and give the institution what they need, then obviously you're looking to provide the numbers in conjunction with what they're asking for and hoping to provide them in such a way that you're looking good. If you're using your ratios for your own purposes to be comparing to other people, then you just want to make sure that you're doing your ratios in such a way that they're comparable to other people, that you understand them. So I'm going to go down here and just look at, this is some information from Wells Fargo website, so you can look at your banking institution to get some kind of guidance with these types of ratios to see what kind of standardization that particular institution is looking at. So they have here our standard for debt to income ratio. Let's first look at the calculation down below here. It says how to calculate your debt to income ratio. Your debt to income ratio, which they're calling the DTI. Also note that that name in and of itself is a little deceiving, because we're not really comparing the debt itself. We're looking at kind of debt payments, the payments that we're making, not the actual balance or liability balance compared to the income that we're earning. So we're looking at the outflow relation to the debt compared to the income that we are earning. So, and then we have, so your debt to income ratio, they like to call the DTI, compares how much you owe each month to how much you earn. Specifically, it's the percentage of your gross monthly income before taxes. So that's going to be a key question that, again, could change depending on where you're basically doing your calculation for, that goes toward payments for rent, mortgage, credit cards, and other debts. Now, note here, a little bit of a deviation, once again, because mortgage is a debt. That's a liability that you're paying off. Credit cards are things that you're paying off, and other debt are things you're paying off. But rent isn't debt. Rent is rent, right? It's an expense. You're incurring it as you go. But they want that in there because it's similar to kind of like the home costs. And if you've made a commitment to paying that rent, they're going to want to include that. So that's going to be one of those factors, again, which if you're comparing or using someone else's calculation, they may or may not include rent, given the fact that it's not really technically a debt situation. So you want to make sure you're picking up the right stuff depending on what your comparisons are. To calculate your debt to income ratio, step 1, add up your monthly bills, which may include. Now, we're not looking at all of our bills. We're looking at mainly the debt bills and any other bills that they're saying are debt-like that they want to include. So the monthly rent or house payment, obviously, again, the mortgage would be debt, but rent's not really debt, but they want to include it here because they're seeing it in the same kind of category. Monthly alimony or child support payments. So if you're making payments, alimony and child support, they want to include that here. Student auto and other monthly loan payments. These are actually loans, student loans, auto loans, and other monthly loan payments. Credit card monthly payments. So then the common question with the credit card is, Are you talking about what I'm expecting to pay off in order to pay off the credit card, what I've committed to, or they want here simply the minimum payment? So you're just picking up the minimum payment here on the credit card. And that could give some level of standardization, again, to the financial institution, because they know if someone is trying to get a loan, that's probably what they will do, right? If they were given a choice, they're going to give the minimum payment, because that would make the ratio come out to be better. So we're going to use that. And then any other debts, of course, that we have. Note, expenses like groceries, utilities, gas, and other taxes generally are not included. So all of your other expenses, we're not trying to include all the expenses. We're trying to include the debt type things, even though we included some things other than the debt type things in the calculation. And then step 2, divide the total of your gross monthly income, which is your income before taxes. And then step 3, the result is your DTI, which will be in the form of a percent. The lower the DTI, the less risky you are to lenders. So obviously we want the DTI, if we're trying to get a loan, to be lower. That makes us look better. And if we're looking for a loan, then we want to have it lower, and so we can look better. So we have our information. We got the monthly home payment or rent, which we're going to say is $2,000. That's how much we're paying for it, either the mortgage or the rent. We have the student loan payments. We're saying we're paying off on a monthly payment of the $300. We have the auto payments. We're saying that we're paying $450. And then credit card minimum balances. Remember, when you're looking at the credit card, then you're not required to pay. You have a range that you can pay, of course. You could pay the whole thing off if you want, but the minimum balance is what they want here. So they're looking for the minimum balance. If you're doing it for your own purposes, then again, you might choose something a little bit different. If you're committed to something higher than that, the institution would probably want just simply the minimum balances, because they're trying to standardize what would happen for multiple people so they can use that for their comparative purposes. And then we've got the gross pay. This is another area where you could deviate if you were doing this on your personal basis, compare it to like your net pay, which you're actually getting from your employer, or to your gross pay. The gross pay is something that you would be getting on the pay stub. So if you had the pay stub, then you'd have the gross pay and then everything they took out of it, which includes taxes, Social Security, Medicare, and the federal income taxes. Again, you could do this kind of ratio if you wanted to. You're looking at the net pay, the amount that you actually got on your pay in your bank account, and do a similar calculation, which might be useful for your own personal comparisons from over time. So again, the standardization here, you want, if you're working with an institution, you want to make sure you do this ratio in conjunction with the institution. If you're comparing it to yourself, you want to use the ratio you think is best suited for you. If you're trying to compare with some other financial guru or some other individual, then you want to kind of line up your comparisons to theirs so that you have the same ratios that you could basically compare out. Also note that your gross pay, if you get paid like monthly, it'll be easy to figure out. It'll be on your pay stub. But if you get paid like bi-weekly or semi-monthly, if you're an annual salary person, you could take your annual salary and divide it by 12. But if you get paid hourly and you're trying to figure it out, typically, and we might do a practice problem on this, typically you'll annualize it and then you'll divide by 12. That's because there's unevenness between the periods, meaning there's about 52 weeks in a year, about 365 days, and there's 30-day months and 31-day months. So there's about 4.3 weeks in a month. So when we try to take our bi-weekly number and get to the monthly number, it can be a little bit confusing. Typically, again, if you're getting paid weekly or bi-weekly or semi-monthly, you'll typically want to annualize it and then divide it by 12, and that's usually a little bit more accurate format. But we might talk more about that in a future presentation. So then once we have those numbers, we can put them into our calculation. So we're just simply going to take the debt payments. This is the amount that we're paying for specifically debt. And we had our monthly home payments or rent, the student loan payments on the student loans, the auto payments on our auto loan, and the credit card minimum balances. Those then adding up to the $2,880. We're just simply adding those 4 items up. Notice that does not include our other expenses like food and whatnot. We're just taking into consideration the debt kind of related expenses. And then we're going to take that 2,880 divided by 5,500. And that's going to give us, if we make it into a percent, moving the decimal 2 places over, about 52.36%. So now we could compare that then to other people. We might have other people that make more or less money on their gross pay. And so I can't really compare their debt. If they make more money, then if they have more debt, then they're probably okay with that because they have the money to pay off possibly the more debt. But we can compare on a ratio basis, and notice that's what banks have to do. If a bank is looking at a loan, how are they going to possibly deal with multiple different people to determine whether or not you can pay back the loan, which is what they're trying to determine. If you can pay back their loan, they're happy. They want to give you a loan because they want to get the interest income on it. But how can they possibly determine multiple different people, all who have different circumstances? They have to use the ratio analysis, right? So that the fact that banks use that should tell us that can be a way to help us to do our comparisons to other people and see where we are at, even though other people's circumstances on a dollar basis will clearly be much different. We want to know how much they're paying on the debt compared to basically the gross income. So like I said, you could line this up, like what you're including in the debt payments, how much of the credit card payments you're actually paying or committed to. Are you talking gross pay or net pay? You could do those calculations a little bit differently, and they might tell you, you might like to do them a little bit differently on your personal finances, and that might be fine. You could do that as well. But when you're comparing to other people, of course, your goal is to standardize it, to try to get your comparison to be equal to what the other person is doing so that you can be comparing the same thing to the same thing. Okay, so let's look at the results category here. So our standards for the debt to income, the DTI ratio, once you've calculated your DTI ratio, you'll want to understand how lenders review it when they're considering your application. Take a look at the guidelines. So if you're at 35 or less, you're looking good. Relative to your income, your debt is at a manageable level. So they're saying 35 or less, then you're okay. So you most likely have money left over to save for spending after you've paid your bills. You can measure whether that's the case. Is money tight for you? I mean, if you're around the 35%, then they're saying here that you most likely have the money, enough money to be okay and whatnot. So you can kind of, think about that yourself. Is that the case? So lenders generally view a lower DTI as favorable. So obviously lower is better here. 36 to 49%. Opportunity to improve, so we're in the yellow zone. You're managing your debt adequately, but you may want to consider lowering your DTI. This could put you in a better position to handle unforeseen expenses. If you're looking to borrow, keep in mind that lenders may ask for additional eligibility criteria. So they might want like a cosigner or something, collateral or something. And then 50% or more, take action. You may have limited funds to save or spend. And so that you could be in a danger zone here. With more than half of your income going towards debt payments, you may not have much money left to save, spend, or handle unforeseen expenses. With this DTI ratio, lenders may limit your borrowing options. So obviously we're in a kind of danger zone just over the 50% here. So that would be a tough lending possibility. Note that if you look at this ratio, then of course, if the debt goes up, that would obviously be bad, and that would be increasing the ratio because that would be increasing the numerator. If the gross pay goes down, then that would be bad as well because then you'd be decreasing the denominator, which would increase the total outcome, and the higher the number, the worse we are, right? So if you were able to structure your numbers, then if you had any kind of leeway in terms of what you could include in the debt or what not to include, then of course you would like to not include the debt if you're trying to look good for the loan purposes, meaning that's probably why, for example, on the credit cards, they're requiring a minimum balance, even though you may be committed to paying more than the minimum balance, because they know when someone's looking for a loan, they're just going to use the minimum balance typically because that's going to make the numerator as small as possible. And again, if you're doing this on your own for your own calculations, you might do something a little bit, you might change it a little bit for your own purposes. And so that's how it looks. And then again, for the bank, obviously you'd be trying to, within the regulations that they provide you, to look better, which means a lower number Here, when you're trying to compare to prior performance or to other people, then just for your own purposes, then you're trying to get your comparisons as accurate as possible so that you can get a ratio that's a good comparison between the entities that will give you information on how you might make changes in the future.